Somebody asks a friend at a barbecue, what should they invest in? They get an answer and it goes and does it. No conversation about what the money is actually for. No conversation about when they'll actually need it. Just a ticker symbol and a hope. That's not a plan. Hope is not a strategy. That's a guess with extra steps. And it happens more often than people realize. Someone hears a stock tip on a podcast, sees a headline about a hot fund, or gets a pitch from a friend of a friend who knows a guy. And that's where the investment comes first, and life is supposed to support whatever comes later, if it comes at all. Today, we're talking about why the order of operations matters. Income first, investment second, a plan, and why that plan has to be something you keep revisiting, not something you just file away on a shelf and forget it. Welcome to On Course Financial, charting your financial future. I'm Chris Brumlow. I'm a partner with the BAB Group, a financial professional, investment advisor representative, and a retirement planning specialist. The BAB Group is a proactive wealth management, accounting, and tax firm that serves individuals and small business owners. Our job isn't just to hand you the numbers. It's to help you understand them, connect them to real life and real decisions, and use them to plan for a future instead of just reacting to the past. That's what today's episode is about. Why holistic planning comes before everything else. Successful outcomes start with aligning investment strategies to each client's unique goals, not the other way around. I mean, that sounds obvious when you say it out loud, but most people do it backwards. They pick an investment, they pick a fund, a stock, an annuity, only later to find out and to figure out, I'll figure out how it fits in my life. They operate between fear and greed. Holistic planning means every piece, your taxes, your investments, your insurance, your business, your income, your estate plan, all gets worked together because in real life, they're never actually separate. A tax decision changes what you can invest. A business decision changes what your estate plan needs to say. Treat them as disconnected pieces and you'll end up with a plan that fights itself. Here's a simple version of that. Say someone decides to convert part of a traditional IRA to a Roth IRA without looking at anything else going on that year. On its own, that might be a smart move. But if it's in the same year that they're also selling a piece of real estate or their business had a record year, that Roth conversion could push them into a higher tax bracket and cost them far more than they ever expected. Neither decision was wrong by itself. The problem was that no one looked at them together. That's holistic planning. That's what it actually means in practice. Not adding more complexity, just making sure that the pieces that you already have are actually talking to each other before you add anything new. Income first, then investment strategy. So if holistic planning is the mindset, here's what it actually looks like when you put it into practice. Here's the order we actually use. You start with income needs. That's based on your expenses. That's today and the ones you'll have in the future. 5 years, 10 years, 20 years, or more from now. And only then organize and optimize the investment strategy and ultimately the investments to meet them. You break it into two buckets. First, what do you need to have this money do and produce right now? What are your living expenses, your business reinvestment expenses, your debt payoff, funding a child's education or activities? That's the now bucket. And it usually calls for accounts and vehicles built around liquidity and stability, not aggressive growth. Secondly, what will you need to produce later? What income will you need in the future? Retirement income, a spouse's income if something should happen to you, a child's education, a business exit payout? That's the later bucket. And it can usually tolerate more time in the market, more growth-oriented positioning because you're not touching it for years. Even with that later bucket, timing still matters. There's money you'll need in 5 years. It shouldn't be necessarily positioned the same way as the money that you're going to touch in 25 years. The further out the need, the more room there generally is to ride out the short-term volatility in exchange for long-term growth. Only once these two buckets are mapped out does it make sense to ask which investments, which accounts, and which strategies actually meet them. That might mean a brokerage account for near-term flexibility, a retirement account for long-term tax-deferred growth, or in some cases, making sure that you have insurance-based products, either for guaranteed income later on or to cover the just in case. None of these tools are good or bad in isolation. They're only right or wrong relative to the income timeline they're supposed to serve. An investment that's technically good but doesn't match the how you'll need the money isn't actually a good fit for you. The goal isn't the highest return in isolation. It's the return, the timing, and the risk profile that gets you to your future income reliably. You need to have a plan that adjusts as life changes. Here's the part that surprises people. Even with a plan built exactly the right way, income first, it can still go stale. The plan you build the day you start working with an advisor is not the plan you'll be using in 10 years or 20. And it shouldn't be. Life changes. Businesses get sold. Children are born. Marriages end. Health issues appear. Tax law shifts and changes beneath you. And we've talked about that on this show in more than one occasion earlier this year. Think about how much can shift in a single decade. Someone in their 40s building a plan around raising young kids and running a business 10 years later is often looking at college tuition, an aging parent who might need care, or a serious conversation about when and how to exit that business. None of those were necessarily on the table when the original plan was built, but the plan has to have the ability to make room for them as they show up. A rigid plan built once and never revisited isn't really a plan at all. It's a snapshot of life that you no longer have. The plan has to flex with you, or it stops doing its job. Here's why monitoring of that plan is not optional. It brings up the part of the process that actually catches the changes before they become a problem. This is the piece that a lot of people skip. They built a plan, they felt good about it, and they never look at it again. Or they do when something forces them to. A market drop, a life event, a tax bill they didn't expect. Ongoing monitoring is what catches a plan from drifting off course before it becomes a crisis. Regular reviews are what is necessary to build a plan and have it actually work for you now. In practice, this just means sitting down at least once a year and asking a list of short, honest questions. We typically do it 4 times a year, once a quarter, because we feel like that's a little bit more appropriate to keep life's changes from catching up with us. You should ask, has our income changed? Has our needs for income changed? Has our risk tolerance changed? Did something happen in our life? A job change? A health event? A new grandchild that the plan didn't account for yet? Are we still on track for the goals that we set, or has the market or life moved the target? It's a short list, and it usually doesn't take long to work out, but skipping that conversation for years at a time is how a perfectly good plan quietly becomes the wrong plan for the life that you're actually living. Let's look at a practical example. Consider a business owner in their 50s. 10 years ago, their plan was built around growing that business and funding a retirement account. Since then, they may have had children late in life. They've taken on a business partner, and they've started thinking seriously about exiting that business in the next decade. If nobody revisited the plan, it's still optimized for a version of their life that no longer exists. Once that plan is updated for where they actually are, the investment strategy underneath it needs to be re-optimized to match and not in the reverse. Now compare that to someone already in retirement. Their original plan may have been built entirely around accumulation. Save aggressively, invest for growth, worry about spending later. But once they actually retire, the question flips. It's no longer about how much they can save. It's about how much reliable income can that portfolio produce month after month, year after year without running out. If that shift in focus from accumulation to income never gets revisited, someone can end up investing like they did when they're 35 and they're actually 70, taking on more risk than their current stage of life calls for. It's the same principle, 2 very different stages of life. The investments have to serve the income needs of the person that you are today, not the person you were when the plan was originally built. That's really the whole episode in one sentence. The income comes first. The plan is built around the income, and then the investment strategy and tools in the strategy exist to serve that, not the other way around. Here's the takeaways. If you only remember 4 things from today's episode, make it these. First, start every investment conversation with a question, not a product. What does this money need to do? And when does it need to do it? If you can't answer that clearly, that's the conversation to have before picking anything else. 2, separate your income needs into now and later, and make sure your investment strategy is actually built around both, not just whatever one feels the most urgent this year. 3, put a review on the calendar. Annually at minimum, I really recommend quarterly, and anytime a major life event happens. Rather than waiting for a market scare to force the conversation, a scheduled review is calm and proactive. A market-driven one rarely is. 4. Remember that a plan you haven't revisited in years isn't a staple plan. It's an outdated one that hasn't caught up to your life yet, even if nothing about it looks obviously broken on paper. If you can't remember the last time someone looked at your whole financial picture together, taxes, investment, insurance, goals, all at once, that's a sign it's time for a real planning conversation, not just another investment decision. It doesn't have to start with a big commitment. It can start with one conversation about what your money actually needs to do for you. That's it for today's episode of On Course Financial. If this helped clarify something you've been wrestling with, share it with someone else who needs to hear it. Hit like and subscribe to our podcast, and we'll see you next time. Until then, stay on course. Investment advisory services are offered through AlphaStar Capital Management, LLC, an SEC-registered investment advisor. SEC registration does not constitute an endorsement of the firm by the Commission, nor does it indicate that the advisor has attained any particular level of skill or ability. AlphaStar Capital Management and the BAB Group are separate and independent financial entities. The information shared in this episode is for general informational purposes only and is not intended as legal, tax, or investment advice or a recommendation of any of the particular.